Good morning and welcome to this Wednesday, December 9th, 2020 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, hump day. Got pretty good action continuing in the market. We really haven't seen much in the way of selling. Futures are, kind of mixed. I mean, we've got looking pretty good on the Dow. Last time I looked, I think the Dow was up about 100 points or so, Dow futures. S&P roughly about 5.5 points, and the Nasdaq's down just a tad, around 10 points or so. So pretty good action. I think overall we've seen that the Nasdaq has kind of rebounded and held up pretty well on a relative basis. Growth stocks trying to hold in there against value. But there's clearly been this rotation. We'll see whether or not that continues throughout the balance of December and into 2021. But the overall bullishness hasn't changed. I mean, this is something we've been talking about at Earnings Beats now for many, many months. Wrote about it in March and April. I believed we were still in a secular bull market. Talked about it at our Market Vision 2020 event going into the year, even before the pandemic hit. That I saw this. I thought we were in a secular bull market, long-term secular bull market, and it doesn't mean that you can't go down. Doesn't mean you can't have cyclical bear markets. We certainly had one of those in March of 2020, but I'm very optimistic going forward. Very optimistic. Very bullish. I can't emphasize enough how bullish I am. I believe that low interest rates, historically low interest rates, and the pent-up demand from this virus, and the market looks ahead. I think the market's already looking to 2021 and this pent-up demand. And there are a lot of folks shaking their head, don't understand. You got the virus, numbers are going up, up, up. There's talking about more restrictions, and yet the stock market's at all-time highs, and folks don't understand that disconnect. But I'm telling you, the stock market, Wall Street, is looking beyond the virus. Now that we have a vaccine, a couple of vaccines, the market is looking to see what we're going to have after we're done with this pandemic. And what we're going to have is exploding earnings and historically low interest rates. I can't stress enough from my background in public accounting and doing valuations how important that is. I see from time to time PE charts being thrown out there. Oh my gosh, PEs are so high right now. Well, a couple of things. Number one, I don't think the PEs are taking into account the huge earnings growth that we're going to see. That's number one. And number two, you can't compare PE ratios when you've got yields down near zero to 20 years ago when yields were at 7%. You can't do it. But anyway, I could go on and on and on. But we do have Market Vision 2021 coming up. And we've kind of thrown that out there in our daily market report the last couple of days, little teaser, but it is coming. It's going to be next Saturday, December, the 19th. Really excited about it. And, last year for 2020, Market Vision 2020, had some of my really good friends, great technicians from stock charts who joined us. I don't know, I think we had maybe 9 speakers. Something like that. Everybody kind of gave their take. I'm going to take a little different approach this year. And, now that Earnings Beats, when I went back as Chief Market Strategist back in it, and by the way, I haven't shared a screen or anything yet. I'm sure I'll probably get questions about that in a minute. I'll move on here in just a minute. But as I look back after transitioning back to Earnings Beats as Chief Market Strategist back in September of 2019, I kind of had this vision of Earnings Beats becoming a research and educational platform to help people manage their money better. I didn't really want to go the route of just saying, here, buy this, sell this, buy this, sell this, for a couple of reasons. Number one, I think it's irresponsible for anybody to do that because we don't know who's on the other side receiving this, even if you want to call it education. I'm not a registered investment advisor. No one at Earnings Beats is a registered investment advisor. Earnings Beats itself is not a registered investment advisor. So we're not licensed to give out advice. So anybody who's throwing stocks out there and saying, here, buy this, sell that, they really technically should be registered investment advisors. And if they're calling it education, that's fine, and putting all their disclosures out there. But it's still, in my mind, somewhat irresponsible because there are varying levels of risk with every trade you make. If you go out and you buy, Disney, pandemic aside, but if you buy a stock like Disney, one of the Dow stocks, it tends to be less of a mover. That's completely different than going and get one of these small renewable energy stocks, Plug, some of these companies that have just gone crazy and they move in both directions wildly. And you don't know who you're talking to on the other end. So I think it's more important that we focus on the research side. I think combining what we do with stock charts is so powerful. And I think our results, in terms of our portfolios, the things that we put together that we teach leading stocks and leading industry groups, I think all of that combined with the tools and features over at Stock Charts are really powerful. So in this Market Vision 2021, I want to be able to essentially to talk about earnings beats and stock charts as we move into 2021 and the power behind combining the two services. So I have two guests that are going to be speaking with me on Saturday, the 19th. Grayson Rose from Stock Charts, Director of Operations, or Vice President of Operations, I believe. Grayson will be joining me. Grayson he knows all things stock charts, and I really want him to talk a little bit. I mean, he's got some great technical information I'm sure he's going to share as well, but I want him to talk about stock charts and what 2021 looks like at stock charts. I think it's going to be a fascinating discussion there. And then also joining us from Stock Charts will be David Keller, who's their chief market strategist. He's the host of The Final Bar, which is aired, well, in normal non-pandemic times would be aired at 4:00, right after the market closes. Their, flagship afternoon show. And Dave's going to be going to talk a little bit about Stock Charts TV. He's in charge of Stock Charts TV. He's going to talk a little bit about the market, what he sees there. And it's just going to be fascinating because, again, I think the combination of our platform with their platform, our research and educational platform, along with their tools, features, education, content, charts, everything is really just kind of fits like a glove. And so the theme for this year is really what I'm calling rising above. And it's taking the information there to help rise above whatever it is you're trying to rise above, the competition, the S&P 500, breaking out the new highs. I'm bullish. I think we're going higher, and I think it'll be a fascinating Market Vision 2021 event. So that, mark your calendar, next Saturday. It's probably going to be 5 hours. I think I'll probably talk for a couple, have Dave and Grayson come on for an hour each, and then I'll probably wrap up for an hour. That's probably how it's going to go this year. Still working out some of the details, but we will be providing a lot more information here over the next couple of days. The other thing, haven't even discussed this with my partner at Earnings Beats. I don't know if he's listening in or not, but we're going to have a special next week as well, which is going to be the equivalent of our best special ever. So all of this, as we get ready to wrap up 2021 or 2020 and head into 2021, I think it's going to be a great next week or so. Keep your eyes and ears open for some additional information coming out from Earnings Beats on not only Market Vision 2021, but also the special. All right, let's move on. That's a lot of no charts, nothing for you to look at. But let me bring up, for those of you who are new to Earnings Beats, give us a try. We have a free trial, by the way. You pay $7 up front just to get you in input into our system, but we'll refund the $7 to you. So for 30 days, there's no cost. And after 30 days, you don't want it, fine. Just write in, cancel, you're done. If you just want to try and get used to us, maybe you're brand new to Earnings Beats, you don't have any idea what we're doing. put your name and email and address in here and hit the subscribe button. This is a free Earnings Beats Digest newsletter. Mondays, Wednesdays, Fridays comes out. No credit card required. You can unsubscribe at any time. Really, I look at it as a way of just giving back to the community. Some of the things I've learned over the years. If you really want to put all that to use and get the most out of what we do, you want to be a member. But if you just want to learn some things about the market, how we approach the market, I think the EB Digest is a great way to get familiar with Earnings Beats and what we do. Literally, we have thousands and thousands and thousands of folks that are on our free newsletter. And there's a reason why we have that many. I think it's a great educational newsletter and something that can help you in your trading or investing. All right, and check out, I've got to mention, I know I promote this a lot, but I'm really proud of this. Our model portfolio, which we started just over 2 years ago, all we do, it's so simple. The beauty of it is in its simplicity, I think, and transparency. Once a quarter, we announce to our members the 10 equal weighted stocks that are going to be in our portfolio and are going to be held for 90 days. No exceptions, no stops. If you want to use stops, feel free to use stops. We're not holding your hand, to the buy button and not allowing you to access your account. I mean, feel free to do whatever you want with the model portfolio, but that's our style and our strategy, just to teach, if nothing else, the impact of being involved in leading stocks and leading industry groups. So our model portfolio, every 90 days, every 3 months, we announce 10 equal weighted stocks. Not equal number of shares, equal dollars into 10 different stocks. And you just hold them for 90 days. And after 90 days, you sell them and we announce the next 10. That's simple. We are into our 9th quarter right now. Our last 8 quarters, we've beaten the S&P 500 7 out of 8 quarters. We didn't do it every time. So we did have one quarter, I think we trailed by about 7 percentage points. So it certainly is no slam dunk. And if you had asked me 2 years ago, would we outperform the S&P 7 out of 8 quarters? I would have probably said no way. Maybe 5, maybe 6. Overall, the big picture, I would like to outperform the S&P 500. Never in my wildest dreams did I think we would outperform 7 out of 8 times. 5 of those 7 quarters we've outperformed by more than 10 percentage points. I mean, it's been crazy, but there you can see the total return is now 200%. That's a triple. 100% is a double. 200% is a triple in just over 2 years. And you can see this quarter up 12.7%. The S&P is up 3.3%. So we're almost up 10 percentage points again this quarter, and we're only 3 weeks into the quarter. I mean, it's really been phenomenal. It's been eye-opening even to me. But if you want to know what's in our portfolios, we have 10 different stocks in each of our 4 portfolios, equal weighted. So 40 stocks in all. We will, if you're a Stock Charts member and you sign up, you can download these right from our website. You can download the chart list right into your Stock Charts account. In addition to our strong earnings chart list and our strong future earnings chart list and our raised guidance chart list and our strong accumulation distribution chart list, our short squeeze chart list. Sometimes we'll have Max Pain once a month. We get a chart list there. So much information that we put together for our members. But anyway, those numbers are outstanding and astounding all at the same time. But I think a lot of what we do, we couldn't do without, what we have at Stock Charts and tying in all of it together. So I think getting back to my original thought process on the Market Vision 2021, I think it's going to be a great event. All right, let's move on and take a look at what happened in the market on Tuesday. You see the Dow Jones Industrial Average up 100 points. We're just slowly working our way up, 30,173, up another 100 or close to 100 in futures this morning. So might be starting off at or close to another all-time high. S&P 500 up 10, first close ever over 3,700. NASDAQ up 62 points, setting another record, 12,583. Mid caps up 13, small caps up 9. Look at the percentages there, leading again. Finally, we've got small caps, mid caps leading the charge to the upside. So exciting. Energy rebounding, continuing to lead. It seems like energy these days is either first or last on the sector leaderboard. I don't know if you've noticed, but I go through and provide you leaders, sector leaders. Monday through Thursday on my Trading Places live shows. And I usually show the two top sectors and then the one that's lagging. And it seems like the XLE has either been in this first position or third position every day for about the last month. That's probably not true, but it just seems like it. Anyway, energy had another good day, up 1.5%, continuing to trend above its rising 20-day moving average. I just want to see that continue to do that. Eventually, and we're almost on the cusp of having a slight negative divergence, but I'd give this a chance. If we break out again, I think that you may see that PPO turn higher again and eliminate that negative divergence. But anyway, watch that rising 20-day. That's always important in an uptrend. Healthcare also had a good day yesterday. Healthcare tends to like December and into January. We'll talk about that a little bit more in a bit. But we are starting to see a little bit of strength there, bouncing off the 20-day moving average. This double top got the breakout above 109, went right back down, tested 108, 109, 20-day moving average. Now we're turning back up. All of these are, really hallmarks during a bull market. Real estate generally likes the month of December. It hasn't really done much so far in December. It is hovering right at its 20-day moving average. Nothing wrong technically, but the stock did underperform yesterday, down about 0.5%. The number one industry group yesterday technically was coal. And I'm going to talk about coal in just a couple of minutes, but I don't usually trade coal, and there are really only a few coal stocks anyway, as part of the coal index. So I wanted to point out the fact that renewable energy, coal, by the way, was up like 6 or 7%. So it was easily the best performing industry group. But the renewable energy group was up 3.5%. And I think technically this is kind of important because after breaking out above about the 215 area, we went back down and tested not only that price support, but also the 20-day moving average. And now we're starting to turn back up. Nice move, up 3.5% yesterday. For now, we're range bound. I would be watching maybe about 215 downside to about 250, 255 upside. So right now that leaves us a little bit more upside than downside. I like the group. But further out, I mean, if we get up to the 250 level, I don't know that I would assume, I think eventually we go above it, but I wouldn't assume we're going to do it on this first move. So we might go up and test it, pull back, maybe hit the 20-day again. Maybe we have a false breakout with a negative divergence. You might want to be careful because then we could actually fall back all the way to test the 50-day. I think if we did that, what would probably happen is we go up, have a negative divergence, all the while the 50-day keeps rising. And then when we come back down, maybe we retest this 215 level again at the same time the 50 comes up from underneath. That's something, we'll be talking about and we can think about it down the road. But that's how I could see maybe something setting up here. Kind of similar to back here. You see how we went down and then we rose back up, had a negative divergence on the higher prices. And then we went back a little bit below the 50, but we held above the price support and right about that breakout level, actually. So I could see something, a little bit more selling further down the road. I don't know if we're there yet. Home builders normally loves the month of December. And this is probably about as counterintuitive an industry group that you could think of from a seasonal standpoint. You would think home builders, wow, maybe March, April really would start rolling, because of home sales picking up and construction and everything else. Home builders actually do better in December and January. But so far this December, not so great. I would watch these lows, and I'm going to talk about this group in just a minute as well. So we'll talk about that more in a bit. All right, 10-year Treasury yield rising today, up 3 basis points. Really not much in terms of economic news. I think there might be a wholesale inventory report out or something, but nothing that's going to be a big mover in the market. Yesterday, I pointed out on the show, it's in a channel. So if you connect these highs and then drag that slope of the line down and connect this low right here, I think we're probably looking at still a range, upper range around 0.97, which I think we're going to break above eventually. And I think to the downside, I don't think we're going to go back down below about 0.82. I'd be surprised. That's the gap up when we had the vaccine news on November 9th. We gapped up from 0.82, went back down, tested that level. Now we're back up near the high again. I think we're going to break out. I don't believe we'll go back down below 0.82. Something would have to happen. Maybe this, if the U.S. decided to shut down for another few weeks or a month. I mean, I don't think that's going to happen. But if coronavirus really, continues to explode and our hospitals get overwhelmed and the government decides, okay, we got to do something again, That would be probably the only scenario that I can think of right now where we might see a lot of folks jump back into treasuries and send that yield low. All right, moving on to talking technically, wanted to just mention the coal. Talked about it a little bit. We've seen coal breaking out before. We saw this in June. We saw this in September. And then after that, after those huge moves, look at what happened. We went right back down, set a new low. We went lower than April in coal. So, yeah, I know the excitement's there, but just be careful. If you're going to, I get emails sometimes like, you're missing the move in energy. You're missing the move in this area. And I don't feel like I'm missing anything. I mean, I've been out of energy since 2011. I mean, go back and look at the chart. Energy's been underperforming for 9 years. I'm, in the short term, and I've said this plenty of times before, when you're trading up like this, if you want to, follow the short-term momentum, by all means, go ahead. The only thing I would say is don't make excuses for the group or the stocks if they turn lower and they fail to hold on to what should be good support. If you're trending higher, you should hold the 20-day moving average. When we broke out here back in June, we went right back through the 20-day like it wasn't even there. When we broke out in September, shooting higher, we went back below the 20-day like it wasn't even there. That's not how you trend. So I'm okay with coal in any of these areas. Gold I was fine with in the short term while it's going higher, but I kept saying, if it breaks back below that 20-day moving average, get out. And I would say the same thing about coal. So I'm okay with it. Short term, long term. I mean, look at where we are versus where we were back in January and February. We're still down 50% from the February high. The market's at an all-time high. I don't need to show you a relative strength chart for you to realize coal is a horrible relative performer over the long term. Yes, a lot of momentum traders jump in when we get a little bit of hype, but you better make sure you're in at the right time and out at the right time, because the majority of the time, if you take out these 3 days and maybe this week and maybe the last few weeks with the vaccine news, I mean, really 2020 has been horrible for coal. So just keep that in mind. Home construction. All right, home construction is consolidating in my mind. We've had a huge run up, put in the high in October. I'd really like to see this 1075, 1080 area hold, just because, we had the low in September, went a little bit below 1100. Same for October, same for November. And here we are, trading below the moving averages, still above that, 1085, 1080, 1085, 1090 area, but not exactly healthy. If I look at the seasonality and go back the last 20 years, you can see November was strong, averaging 3.3% gain over the last 20 years. December only goes up 60% of the time, but it averages a gain 3.2%. January goes up 70% of the time, averaging 4.0% return. So you see this is what I was talking about, counterintuitive. If I didn't know anything about the stock market and somebody said, when do you think home builders would do well? I'd say April, spring. Everybody's out buying, shopping for a home. That obviously is when home builders would go up. Well, maybe it's the anticipation of what's going to happen in April. I don't know, but November, December, and January are your 3 best months for home builders. All right, let's see. I think there was another one, a couple of them I wanted to show you. Get back into my notes here. Let's take a look at the XLRE. So this is real estate sector. Another group that loves the month of December. This is the best performing sector in December. Right now, where we closed in November, we're up slightly. So not really having what I would consider a typical November. November 30th, we closed at 3650. Right now we're at 3679. So we're up less than 1%. We're underperforming the S&P 500 right now. That might change. And if we look over at the seasonality and pull up the XLRE and go back 20 years, you'll see 70% of the time goes up in December, up 3.2%. And then if you want to see relative strength seasonality, you can just compare real estate to the S&P 500, which is $SPX. Hit the go. I'll give you the 5 years, drag it back 20, and you'll see XLRE outperforms the S&P 55% of the time in December. and averages going up more than the S&P 500 by 2.6%, and add another 1% that it typically outperforms in January. So this is the time of year real estate tends to do pretty well. Now, I don't see anything horrible on the chart. We're holding in there right on the 20-day moving average. I could see a bounce right off of it and a new high coming. So, I'm not a huge fan of defensive groups because I believe we're in a secular bull market, and I think defensive groups will take a back seat to the more aggressive groups in 2021. But that doesn't mean that I don't believe real estate's going to go higher. I think it's going to go higher. I think all of our sectors are going to go higher. I think the question is which ones are going to lead. And I don't think real estate's going to be a leader in 2021. Could it resume some, leadership in December? Yeah, historically it does that, and it doesn't look bad technically. I could see a bounce coming. And the last one I wanted to pull up here is the XLV. So the XLV jumped into that number 2 sector spot yesterday, had a nice day, rose 0.75%, bounced beautifully off the 20-day. This is what I was talking about at the open. So you've got the double top right around 109, 109.5, went back down, tested that level. That was after getting up close to 115, came back down, tested that breakout level, tested the 20-day, and now we're rolling back to the upside. Nothing wrong at all with this chart. I think the XLV goes higher. Now, when we look at the XLV on a seasonality chart, you also see that it tends to really like the end of the year. November, December, both strong. January strong, 1.1%. So the XLE, November, December, and January over the last 20 years, average is going up over 5%. 5% in 3 months isn't bad. I mean, annualized, that would be a 20%. If you could pull that off, every 3 months, find, something that's going to go up 5%. So the numbers are pretty strong, and you can see November and December very strong as far as tendency for the month to close higher, 80%, 70%, 65% in January. I would argue those are the 3 best consecutive months in the market for healthcare. So another one to keep an eye on. All right, let's move on. I'm going to get into earnings. So there were quite a few earnings that came out in the software area. And I'll get into a couple of those. 2 of them, I guess, came out in the software area. I'll get into those just a minute. But here is a specialty retailer, Chewy. So Chewy, last time I looked, was set to open fractionally lower. It was down just, minimally, 0.2%, something like that. I think the stock looks really good. This was one that was really, it's not in our portfolios, but it was one of the final cuts. If you're, have a travel team or something, you're going through these series of cuts and you get down to that final cut, or maybe, look at the NFL, how they go through a series of cuts. Well, Chewy made it to our final cut, just didn't survive that last cut. And, but, I like the stock. Look at it relative to the specialty retailers. It's been very strong relative to the S&P, been very strong. One of the things I didn't like was the specialty retail group moving to about a 6-month relative low to the S&P. So that was, one of the final straws why I didn't go with Chewy, but the stock still looks good. They beat on their earnings. They came in with a loss of 8 cents. The market was expecting a loss of 15 cents. Again, stock down fractionally, not much, but the overall chart looks good. I like it on a 20-day test. And you might see some volatility with earnings. Even though it's just down a little bit to open, hard to tell. This stock could be down $8, intraday. Market works in weird ways, and it really tries to play with our emotions. And so don't be surprised, any stock, when it comes out, to all of a sudden see these huge moves in one direction or the other, because they're playing with our emotions. Usually that first move, whatever it is generally the wrong move, because it usually is, if it moves down $8, everybody panics, they get out, and then next thing you know, stock's back up again. That's just the way the market works. MDB, this is one of those software stocks. This is MongoDB. Breaking out recently, came down, tested the 20-day. I actually owned it off of the 20-day for just a period of time. I got out. I didn't want to hold into earnings. Stock was down 1.4% last time I saw. They beat their bottom line. They had a loss of 31 cents. Market was expecting a loss of 46 cents. And if you wonder, well, how can these companies, be losing money and have these big valuations? Well, the valuations are based on their future earnings growth, which, by the way, is probably going to get adjusted higher now that they just beat their earnings. If the last quarter was projected to have 46-cent loss and it was only 31, if that same momentum continues into the future, you have to start changing those estimates going forward, which raises the valuation of the stock. And that's the beauty of a growing economic environment with a very low historic interest rate. And I don't know what to say to the naysayers that I haven't already said over the last several months. And I'm not saying I'm right. I'm going to be proven right in 2021. I'm just giving you my opinion and why. But I see a lot of pent up demand in a lot of different areas of the market. And so I think earnings are going to spiral higher, which is going to take the stock market right up with it. I think we're going to have a really big decade ahead of us. I said decade, not 2 weeks, not a month, not a year, decade. We'll have cyclical bear markets like we did with the trade war at the end of 2018. Probably not anything like the pandemic, where you lose 35% in a month. Can't guarantee that, but that's unusual. But 25% drops along the way over 3 to 6 month periods are kind of normal, even in a secular bull market. So we'll have some of those that'll scare the heck out of everybody. But the market overall, in my opinion, goes higher. One more earnings report, then I'll give it into the three you must see. GameStop down 17%. Now, this is a highly shorted stock. I wouldn't be surprised to see it come roaring back, but I don't own it. I don't have any plans right at the moment to own it. It's incredibly volatile. So if you're somebody who's, concerned, conservative, look the other way. Don't even look at GME. There are so many other stocks out there that are much safer to invest in. Don't look at a GME. But if you're somebody who likes to take a lot of risk, then GME might be right up your alley. Stock was 19 and change 2 weeks ago. Now it's 13.81. So that gives you a sense of the volatility. It was almost, it was $10, 10 and change a month before it was 19. So you got the movement going in both directions. But GameStop did beat. They lost 53 cents. The market was expecting a loss of 81 cents. I haven't seen anything else other than that headline number. But obviously Wall Street, not a big fan, at least at the open. I was looking, down here at this breakout around 13. If it got down to 13, let's see what it's doing here. See if it's down to 1360. Sometimes I'll go to the 5-day and start watching. Although this one, because we don't have anything close, maybe the hourly would be a little better. Yeah, I mean, you can kind of see here was a breakout about 1250 above this high. I might take a flyer, but again, to make money in a stock like GME, you don't need to go in and put a full position like you would on a stock like Apple, which is much less volatile. If GME goes down to 13 and goes back to 15, and I just have 300 shares, 200, 300 shares, that's $400 to $600 that you can make on a $2 move. So, and I know it sometimes, that it's hard for greed not to overtake us sometimes. But just be careful with a stock like GME, because if it goes against you, you don't want to lose a bundle. So if I were going to get into it, if I do get into it later today, it would be to try and just capture a little bit of profit off, a couple hundred, 200, 300 shares, something like that, something very small, something if I'm wrong, I'm not going to, be, really hurt badly on. And when I say 200 or 300 shares, I mean, whatever a small number of shares. I mean, normally a stock like GME, I might buy 1,000 shares, just to kind of put things in perspective. I'm talking about maybe 25% of normal shares. So whatever that means, to you, that might be more suitable. One stock that came out this morning was Campbell Soup, CPB, more conservative play. And you can see the stock down today, almost 2%. If I pull up the relative chart here, look at it on a daily, the stock's been doing nothing throughout the year, even though the market's been moving higher. I look at a chart like this, and I know some of you are probably conservative and maybe they, like their dividend or whatever. I'm into growth. I'm not into dividends. I'm not an income investor. I am growth oriented. I'm trying to multiply my dollars. And the quicker, the better. So Campbell's is, I would look at this chart. and I literally wouldn't spend more than about an eye blink on it. Look at the relative strength. It's not even a leader in the defensive areas. If it was a leader, maybe I could make a case for it, but I would just pass on by. All right, the 3 you must see. I got 3 interesting stocks here for you. And all 3 are in areas that we have talked about already. So I'm going to bring up the first one, which is Arch Coal. So here you got, coal stock trending higher. We were talking about coal earlier. And as long as Arch Coal stays above its 20-day moving average, I'm okay. I'm going to annotate this because I want to show you, when I look at a stock, I see this bottom and then I see this move coming up. So after I look at this, I say, okay, maybe that downtrend is breaking. Doesn't mean I'm going to jump into the stock, but just the way I would look at the chart is I would look at it and say, okay, it looks like maybe things are turning here. Maybe we're starting to build, put in an uptrend. And then we pull back and we put in a higher low. Okay, that's good. Now, if the higher low isn't good, because we could go up here a little bit and then go right back down. So this higher low doesn't get established until we take out this high. So you got a higher high, higher low, and now you need a higher high. Well, we got that in September. So now it's starting to look even better. But we went back down. We failed to hold the breakout level, traded below the 20. And now, in order to keep this higher high, higher low, higher high pattern in play, the pullback has to hold this low or it's negated. Now, if you look at coal, it didn't. It already went down below that prior low. So on a relative basis, you're going to see Arch doing pretty well relative to its group, but its group is horrible. So the only thing I would say when I look at a stock like this is make sure I keep my stop in play. If Arch, if it's trending higher, it should continue to remain above the 20. Now, does this mean I would jump in at $40? There is no way I would jump into Arch at $40 with the 20-day moving average sitting at 35, knowing that it's one of the worst industry groups in the market over the course of the last year. I mean, I'm just setting myself up to lose money, in my opinion. If I'm going to take a chance with Arch, it's when it's down here testing that 20-day. Or, when it's breaking out here and it's testing that 20-day. Because then if it closes below, I just get the heck out. Same thing over here. Coming down, you're testing that 20-day. Don't get it when it's $5 above the 20-day. Then you get a normal test and you're already down 12%, which is going to be playing with your mind. That's when you start making emotional trades and you just get out because, you bought 500 shares and, you're down $2,500 and it just feels like it's going to go below the 20 days. So I'm going to get out. Or it goes below the 20-day intraday and you're afraid it's going to be one of those swooshes to the downside. You get out and then it reverses back and a week later it's at 40 again. And you're literally, looking yourself throwing your hands in the air. So spend a little time on that, but that's just giving you some insight as to how I look at the market. I don't really like to trade stocks that are in areas of the market that have not been performing well for an extended period of time. That's why you don't hear me talking about gold stocks. It's why you don't hear me talking about energy stocks. It's why you don't hear me talking much about material stocks. Of all of those, I would say I like materials more than the others. But, still, even materials I'm a little nervous about. And if you don't know why, go back and see one of my videos from earlier this week. I think it was yesterday's over at Stock Charts, where I talked about, I think the dollar is going to rebound in 2021. If it does, it's going to hurt materials and energy on a relative basis. They may go higher, but if you're trying to outperform the S&P 500, energy and materials probably not the way to go. Next stock I had here on the 3 you must see. I know we're running over a little bit. Sorry about that. AutoZone. AutoZone came out with its earnings, volume picked up, sold off. Again, just to annotate this, and I'll do this one very quickly, I would just watch price support. I'm not a fan again, but here was the high right here. Went down and we tested it. We tested it yesterday, and then bounced off of it. And then maybe a second level would have been something like this, where we had all these multiple tests up around 11.10, 11.15, something like that. And then the second one would have been all these other lows that we've seen. But if we get back down below, 1075, 1070, I mean, we're talking about moving to a 7-8 month low in a market that's setting an all-time high. So you go down, you look at the relative strength, you don't want to own it. I'm not going to try and make an excuse. I don't care if it is at support. I'm not going to buy it. If you're a short-term trader and you see a move down to 1050 and it comes back up and closes at 1075, 1080, a nice hammer, short-term trader, maybe you take a play, trade it. But again, if I got my 2, 3, 4% on it in a day or two, I'd be right back out. This isn't the type of stock I want to trend trade. It's just not, it's just not what I look for in a trade that I might hold on to for a period of time. All right, last one I have, we talked about home builders. And so let's talk about DHI, DR Horton. Now, home builders, I said, haven't been doing very well. DHI, you can see, is down below the moving averages. But there's one difference on this chart that I like. DHI just a couple weeks ago set a new 52-week high relative to the home builders. So if home builders start to move, I want the leader or one of the leaders. DHI is one of the leaders. So if I was banking on home builders rallying again in December or January because seasonality tells me that, and I was looking at a possible position, for me, it would be something like DHI, but I'd like to see it get above the 20 and start trending higher. Or I would like to see it down closer to support. The problem is if it gets down to support, it probably means home builders have broken down. So I really don't want it to go down to support. What I really would like to see it do is move back up above that moving average. And then if I wanted a home builder, now I have a leader. And if home builders start to move, I would expect DHI to do well. All right. That is it for today. That's your 3 you must see. Looking at the market, we got bifurcated action. Yesterday, the NASDAQ did better. Today, it's the Dow and the S&P performing better. So Dow up 0.4%, 129 points, 30,303, moving to new all-time high territory. S&P doing the same, 3710. I think December tends to be a strong month. And I don't know if you remember, but when I pointed out all the way back at the end of October, I said October 27th at the close to January 18th, there is no stronger period of the year. And outside of those first couple of days of this period, right at the end of December, October when we went down, outside of that, we've been rallying. Market's been very strong, and it's so typical. History does repeat itself. It's good to at least have the knowledge. Anyhow, that is it. I want to thank everybody for stopping by, and keep in mind Market Vision 2021. I think it's going to be a great event. Again, lining up Grayson Rose, Dave Keller, two of the folks at Stock Charts that can give you a lot of insight into what's coming in 2021 there. And I can give you a lot of insight of what's coming in 2021 as far as earnings beats goes and the way we're looking at the market. So I think it's going to be a great event a week from Saturday, December 19th. More details to follow. We'll have an agenda up and everything in the next few days. So be on the lookout for that. Everybody have a great day. Be back tomorrow over at Stock Charts for your next Trading Places Live. Happy trading, everybody.